Dear students and viewers, welcome to Curious Commerce. Today, we are going to understand the secondary sector of the Indian economy with a special focus on sources of finance. Whenever raw materials are converted into finished goods, the secondary sector plays a vital role. Industries, factories, construction projects, power plants all belongs to this sector. Let us understand this step by step with real life examples. The secondary sector adds value to raw materials produced by the primary sector. For example, cotton becomes cloth, iron ore becomes steel, and limestone becomes cement. This sector requires capital, machineries, technology, and skilled laborers. That is why finance play a very important role here. The secondary sector converts raw materials into finished or semi-finished goods. It is a capital intensive and technology oriented. Without money, machines cannot be purchased, factories cannot run, and production cannot continue. So, finance is the backbone of the secondary sector. According to definition, the secondary sector consists of industries engaged in manufacturing, processing, and construction activities. This definition clearly tells us that industry and construction are the two main pillars of the sector. The secondary sector is divided into following segments: manufacturing industries, construction industry, power and energy industry, MSME sector, capital goods industry. Each segment has different financial needs. Manufacturing industries are classified into consumer goods, intermediate goods, and capital goods. Examples include FMCG products, steel, cement, and automobiles. Manufacturing industries require continuous finance for production, wages, and raw material. Once again, I will repeat: manufacturing industries require continuous finance for production, wages, and raw materials. Sources of funding for manufacturing industries. Manufacturing industries use both internal and external sources of finance. Internal sources include retained earnings, depreciation funds, and the external sources include equity shares, what the shares are issued to the common public, preference shares, the shares which are having the preferences, debentures, and term loans. Term loans generally from the commercial banks or the financial institutions. The institution sources include the commercial banks and developmental banks. A proper mix of sources reduces financial risk. Once again, I will repeat, a proper mix of sources reduces financial risk. It means the sources of funding for manufacturing industry is the combination of the internal and external sources. On the basis of the industry position, chief finance officer decide which combination is suits to the specific factory or the industry. Heavy industry like steel, cement, and automobile industries. Heavy industries require huge capital investment and long term finance. Heavy industries require huge capital and long term finance. It means that huge capital investment for the longer duration. Their funding characteristics include it should be for the longer term loans, it should be for the project finance, and it is high fixed capital. This heavy industries ought for the sources mainly include equity capital, long term loans, infrastructure bonds, and foreign borrowings. Light industries require less capital compared to heavy industries. The heavy industries require the sources of fund for the huge capital investment and for the long term finance. But the light industries requires less capital compared with the heavy industries. Funding sources include for the light industries. First one is the owner's capital, what we call as in the owner's contribution. Bank working capital loan. It means that working capital loans from the banks, trade credit, credit facility in the trade activities, and retained earning or the retained profit from the previous financial year. These industries depend more on short term finance. Just compare with the heavy industry, they need high capital or the huge capital investment for the longer duration, but for the light industries, less capital for the short term finance. The construction industry. The construction industry includes roads, bridges, buildings, and infrastructure projects. It is a project based industry and requires high working capital. Payment are usually received in stages, so proper cash flow management is essential. For the construction industry, sources of finance in different manner compare with the heavy industry and light industries. Sources of finance for construction industry include project finance, bank loans, public private partnerships, and government contracts. Large projects depend heavily on institutional finance. Once again, I will repeat the high industries requires huge capital investment for the longer duration. The light industries expect the lesser investment for the shorter duration. But in the case of the construction industry, large projects depend heavily on institutional finance. The next industry is power and energy industry. The power and energy industry includes electricity generation through thermal, hydro, and renewable sources. It is a strategic industry and plays a crucial role in economic development. Once again, I will repeat it is a strategic industry and plays a crucial role in economic development. For the power and energy industry, the sources of funding is different compared with the previous industries. Funding sources include for power industry, government funding, infrastructure bonds, long-term bank loans, multilateral agencies. Due to high capital cost, long-term finance is essential for the power industry. The next one is MSME, micro, small, medium enterprises. Thus, MSMEs are the backbone of industrial employment in India. They have small capital base, flexible operations, and local market focus. But they face major challenges in finance mobilization. Sources of funding for MSME sector include the internal, institutional, and informal sources of finance. Internal sources of finance include owner savings, family funds of the owner. The institutional sources include Mudra loan from the central government and SIDB finance, Industrial Development Bank finance, and bank credit. But in this category, the MSME sector, they follows the informal sources of finance also. That thing we call as in the trade credit. Government support is very important here for the MSME because MSMEs always concentrate on the local market. They fulfill the local customers' expectations. Thus, MSMEs or fulfill the satisfaction of the local consumers. That's why the government should be concentrate. They should be give the support for the MSME sector. Capital goods industry. The capital goods industry manufacturers machinery and equipment. The capital goods industry manufacturers machinery and equipment. It has a long gestation period and requires equity capital, long-term institutional loans, and foreign investment. The role of the secondary sector in the economy. The secondary sector plays a key role in Indian economy. It is essential for the employment generation, industrialization, export growth, and technology development. It acts as a bridge between agriculture and service. It means that it is the bridge between the primary and tertiary sector. The contribution to the GDP by the secondary sector is very important. The contribution of the secondary sector to GDP of our nation is increasing from period to period. It strengthens economic growth and supports other sectors. But the secondary sector faces certain problems. The major problems include high capital cost, technology gap, credit access issues, and environmental regulations. Finance remains the biggest challenge. Once again, the finance remains the biggest challenge in the secondary sector. But the government gives the supports for the secondary sector also. The government supports the secondary sector through Make in India, PLI schemes, MSME support programs, and industrial corridors. These initiatives improve access to finance. This is the segment wise comparison table for the sources of finance. The heavy industry majorly depend on the source of finance from the equity and long-term loans. Light industries depend on internal and working capital loans. Construction industries depend on the project finance. Industries depend on the government and the bonds or the debentures. MSMEs, banks, and government schemes. What will be the future of the secondary sector? The future of secondary sector lies in automation, green energy, digital manufacturing, and global supply chain. Finance will decide the speed of growth, right? Finance will decide the speed of growth of secondary sector. To conclude, the secondary sector drives industrial growth. Sources of finance differ based on industry nature. A balanced financing structure is essential for sustainable development. Thank you for watching Curious Commerce. For daily updates, follow the Curious Commerce WhatsApp channel. Let us learn commerce practically. Once again, thank you all.